Good morning, everybody, and welcome. I'm Gianni DePoce, and today is Thursday, the 10th of April, 2025. I'm joined by a very special guest, our friends at Direxion and Elliot Wellenbach. We are going to be discussing how to navigate market volatility with Direxion's leveraged and inverse ETFs and getting into what the outlook for markets could be for the remainder of 2025. Obviously, there has been a lot of volatility. In fact, we have set records in this market, both to the upside and to the downside. So the timing of this conversation today between Elliot and myself couldn't be better because they have some great tools and great funds to help you capitalize on this opportunity. So let's go ahead and get Elliot on and get into it. Elliot, how you doing?
Hey, good morning, Gianni. Doing pretty well. This, like you said, a very exciting time for this webinar, given the volatility
Yes.
last weekend, especially this week as well.
Yeah. Well, it's great to have you back on. And I know I have a lot to talk about and discuss what my top trades in this environment are and where we go from here. But before we do all that, let's talk about how these funds work, because I think it's so very important to, in this business, know what you own. Okay. With the markets moving as much as they are, the last thing you want is to wake up one morning or even in the middle of the day, for that matter, given the heightened volatility, and be surprised with how one of your holdings are doing. So let's make sure that we understand how these Direxion funds work so we can use them to the best of our ability.
Yeah, no, I completely agree. And, fun disclosure slide, we'll get through this quickly, just to make sure, the audience understands just how these work, what they're intended for, and then we'll get to the fun stuff with Gianni. But just on the next slide, just kind of a overview of Direxion, founded in 1997. We're a boutique asset manager specializing in mostly leverage and inverse ETFs, which we're going to speak about today. And we have now over 100 ETFs, right around 40 billion in assets under management. And just you'll see on the next slide of just a overall landscape of leverage and inverse ETFs, just to give a high level picture. So the industry, is now over 112 billion in assets, and you can see it's heavily skewed towards the leverage bull side on the 3x side. So we have a lot of bulls out there. Right now in this market, we'll see how that's going. But it was good to be long yesterday, at least. And just what are leverage inverse ETFs? On the next slide, you'll really get to see just kind of what these are intended for. So these are intended to provide daily leverage exposure. So for a 2x or 3x fund, for every $1 invested, you're getting 200 or 300% exposure on a daily basis. And this is really important just to understand this, because these are really intended as short-term tactical trading vehicles, not as buy and hold investments. And the reason why is because these funds have a daily targeted exposure of either 2x, 3x inverse, or to the long side. But what that means is we're going to rebalance the fund at the end of every trading day to make sure that you start out tomorrow with that targeted 2x or 3x, whether you're long or short on the fund. And that's really important. Just on the next slide, this is just a high level of, and I'm not going to walk through all of this. This is available on our website, so we can get to the fun stuff. But just a high level of understanding, what the daily rebalance with leverage, how that can really impact your a return of a leverage ETF for longer than a single trading day. And really, what's the best way to illustrate is on the next slide of. It sounds corny. I've said it plenty of times on the. This before, is trend is your friend in these products.
I'll steal my thunder, Elliot.
yeah, I know. We'll talk about it plenty. But you'll see in this that the underlying benchmark is steadily trending up over a multi-day period. And you'll see both the bull and the bear fund with that daily rebalance you're actually slightly outperforming over a multi-day period, 3x of the cumulative of the benchmark. And in the bear fund, you're actually down a little bit less than a 3x return of the benchmark. So again, really trend is your friend in these products, even in just a short, trading day horizon. And on the next slide, you'll see in more of a whipsaw environment, kind of what we've been seeing with the volatility in recent days. You should not expect to see a 3x return of the benchmark. You'll see both in the bull and bear fund in this scenario over a multiple day period where there's a lot of volatility, there's a lack of overall trend. That's where you can really you'll see a leverage ETF underperform, and that's not what it's meant to do. It's not meant to provide a 3x return over a multi-day horizon, especially in these types of markets. And that's why these are really intended as short-term trading vehicles. And just, on the next slide, you'll see, who are these meant for? These are really meant for, opportunistic short-term trading, hedging with even single inverse all the way up to inverse 2x, 3x, portable alpha. Portable alpha really means that less capital down to get the targeted exposure you're looking to execute on a trade. And a lot of volatility focused trading, especially right now. And just, on the next two slides, we have our single stock leverage inverse ETFs. I'm not going to go through all these because I know we're going to talk about them later today. But this is a way to get daily leverage exposure on the long side, 2x bull, to some of the most popular and favorite traded names out there, all the Magnificent Seven, semiconductors, as well as a few others. And then we have single inverse on the bear side, if you are looking to potentially hedge a concentrated position that you have in your portfolio, or you're looking to just outright short an individual name. But now that that's done, let's turn it over to you, Gianni, so we can get to some of your slides and the exciting stuff. Oh, we got him back.
Yes, sorry about that.
Well, that was perfect timing because I was saying let's hand it over to you if you're ready with your slides. So
yes, get into it.
Some of the fun stuff.
So obviously, we've had record-breaking volatility. I mean, yesterday was one of the biggest up days in market history, and we've seen some of the biggest VIX spikes in recent memory. So there is a lot of opportunity on both sides of this market. Let's see. Let me get my. Got to share my slides again. There we go. Okay, great. You can see them, right?
Yep.
Yeah. Okay, great. So this is a two-way tape, and I think, given how the market has behaved since the bear trend of 2022, there has been a rising sense of complacency. And it's really crazy when you look at the internals of the market, because even though we saw so much selling in March and, so far this month, stocks were looking pretty good up until mid to late February. We had a big risk off signal come in at the end of February. But even then, we didn't really risk. We weren't really showing signs of a big breakdown. But as time progressed, those signs did increase. And we can start off by talking about semiconductors. Why semiconductors? Well, it turns out that chips are one of the most important sectors in this market overall. And the reason behind that is I want you to think about all of the innovation taking place in the technology space, whether it's AI, now quantum computing, all these big advancements that we see coming from tech starts with semiconductors, because we need to retool basically all of the computers to make them capable of processing, all the AI and all the quantum stuff going on. So, when you see weakness in the semiconductor sector, I view that as a harbinger of what's to come in tech. And we know that technology, especially, makes up about 30% of the S&P 500. So when you have a sector tied to tech and tech making up 30% of the index, when tech's selling off, it presents a major, major headwind for the direction of the overall indices. So that's why I like to pay attention to what's going on in semiconductors. And like Elliot mentioned, the trend is your friend. Interestingly, semiconductors have not made a new all-time high since July of 2024. And this is a problem. This is a problem because without participation from semiconductors, bulls are going to have a tough time. So, Elliot mentioned how the trend is your friend. Let's discuss what that means. Let's dive into that, because how do we identify trends? Well, first and foremost, trends exist across different time frames. And even though these direction products are designed for short-term tactical trading, you need to know as a trader what the trends are across different time frames. So you have long-term trends, intermediate-term trends, short-term trends. I like to start off, by knowing what the longest term trend, looking at that monthly chart, and then dialing it down to the smaller time frames, weekly chart, daily chart. And for fine-tuning your entries on these types of ETFs, even go on the intraday charts. But I have here a daily chart of the Philadelphia Semiconductor Index, and you'll understand why we're looking at this in just a moment. But as you can see here, we've been forming, some lower lows and lower highs really over the last several months. And you might be saying, well, you took out that high from October in January, and that was in a way a false signal because you sold back off, rallied back up into February, and this was that warning sign that I mentioned a moment ago. You formed that lower high here, then you took out these lows from November. That was a big warning sign. You broke down from this pattern here. We like to call those of us that use charts and like to trade based off the charts, called an inverted saucer pattern. By the way, if you're going to be using these ETFs, strongly recommend you learn some of these chart patterns, and there's plenty of resources online to learn these patterns. And once you learn them, they can be applied to all markets. So it really is a valuable tool for traders. And then we broke support, which is what I'm going to talk about here in just a moment. But once support breaks, it becomes resistance. All of these charts that I have here today are as of yesterday's close. So you saw this big green candlestick. We erased only about a week worth of losses. And now today we're seeing a little bit more selling. So semiconductors have some headwinds to overcome here. Can it be done? Yes. But if, and well, I shouldn't say if, it's a matter of when the market bottoms, we look for a sector like semiconductors to outperform out of the low. Semiconductors are known as a leading indicator. They're often the first to top and often one of the first to bottom. So that's why I'm starting today with semiconductors. You had this peak in July, and what were stocks doing even into this year? The S&P 500 made its all-time high in February. So you had a 7-month lag between semiconductors, a leading indicator of the market, and the index topping out. Really amazing when you learn how this stuff works. So, I'm not ruling out a retest of those lows from earlier this week on Monday, but if semiconductors can assume some leadership here and start outperforming to the upside, then we can start talking about a market bottom. And how would you look at capitalizing on that? Well, you have the 3X Bull Semiconductor Fund, SOXL. Okay, so if you want to make a directional bet on the direction of semiconductors, one of the first trades that you can start looking for coming out of a low in this market is in the chip sector. So, what I have here is the support zone drawn out. Okay, it broke. You can see how price is traded in there for a little bit, and when support breaks, it becomes resistance. So what are support and resistance? Let's talk about that for a moment. We can get into all sorts of economic discussions, and you have all these fancy theories. Well, I like to keep it simple. As a trader, I think keeping things simple is going to make your life a lot easier. So let's just take it back to Economics 101 and discuss supply and demand. Support and resistance is simply a way to observe supply and demand on a chart. Okay, and these funds work really good because you can chart them like any other market. When you identify a support zone, it's simply an area supply. It goes up. And you see how prices fell into the zone at first, and it bounced. But at some point, supply exceeded demand. And that's what resistance is. Resistance is simply a level, a zone, a range on a chart where supply exceeds demand. So what I'm looking for here in SOXL is to see how it behaves when it retests this resistance zone that was formerly resistance. How can it handle this overhead supply? We'll know if there's more demand for semiconductors because it'll absorb that supply, it'll break through that, and then it becomes support. And then it becomes support. But what if it doesn't? What if it can't absorb all of that overhead supply and the selling really comes back with a vengeance? Well, then I would look for the fund, the 3X bear fund, SOXS, to catch a bid, to rally instead of SOXL. And that's the beauty about these funds, is you can play both sides of the market. You can play both sides of the market. So whatever's happening, there's always going to be a trade to take. Now, I strongly do not suggest that you do that. Have a plan. Know when you reach a price level in advance. Okay, you want to know the price that you want to buy. You want to know your stop loss. You want to know your exit point before you even take a trade. Do your due diligence. These are not funds to where you're just shooting from the hip and, oh, you know, we had a tweet come out yesterday, so I'm just going to rush to buy out SOXL. No, don't do that, because SOXS instead, because the trend was down, you got burned. You got burned big time. This is a huge move they had yesterday. Now, these moves are not very typical. They're not very typical, but in this volatile market, it's not one to be a hero. There are no winners. There are no losers. There are only survivors in this tape. Make it to the other side. So anything you wanted to add on semiconductors, Elliot? Because I have a whole bunch of other stuff that we can get into as well.
I was just going to say, I cut in and out in the beginning, so not sure if you mentioned it, but yeah, no, I completely agree with what you're saying. And that was we saw the largest single day move in semiconductors yesterday since 2001. So a lot of turnover and heightened volume in both SOXL, SOXS. But let's move on to some of the other stuff that you have coming up.
Yes. Well, we also know that China is in the headlines right now. So I'm looking at the FTSE China 50 index, which is what Direxion's bull and bear triple leveraged funds are based off of. And so China has been a very volatile market. It's been something that's it's been on my radar year to date. It was actually on my radar coming into this year because the Chinese market has been in a bearish trend for many, many years. China basically did not participate in the of 2023. Obviously, we had a bear market in 2022, but the Chinese market has really had some issues after COVID. It never really recovered to the same magnitude that the U.S. market did. But interestingly, going back to that whole trend discussion, we had a really big rally that kicked off in September. And I do want to bring attention to the fact that this happened right around the time where the Federal Reserve made their first interest rate cut back in the fall. They panicked and they cut interest rates by 50 basis points, or 0.5%. Now, you're seeing headlines today even where, China is launching a big stimulus package. They're retaliating with tariffs. They're going to try and support their own economy. I'm actually in the camp that U.S. monetary policy is more important for the Chinese market than their own monetary policy. Why am I saying that? Because you need to understand that money moves and flows between countries, between sectors, between stocks, like water. It's not like China has complete control over its market, even though they do try to, control it to a large extent. But you have to understand that these are forces that are stronger than any central bank, than any government out there. So, it's not lost on me that we had this big run up in China back in September. And then, we pulled back, and check out the support zone, guys. Bounced here in November, bounced here in January. There was more demand than supply in this zone. And then you can take a look at this resistance area where we were only above that for a little bit. Okay. So that's the thing, is that sometimes you have what's called breakouts. And there's a saying in this trading business that goes like, from false moves come fast moves. Was that a fast move? You better believe it was a fast move. But what happened? We bounced off this technical support zone once again. So this is very much a two-way market. And I think there is still a lot of opportunity in this space for the short term. Obviously, there's a lot of regulatory risk rising in China. But if you're trading these, on a daily basis or holding them for a couple of days, I don't think that's the biggest risk that you need to worry about. But for those that have some of the longer term holdings, just be aware of what's going on in the bigger picture. So let's jump into what yin and yang. I love the names of these funds. So you had that big run up in September. You came back down, and then actually year to date, China was one of the most powerful. We saw one of the most powerful rallies across the world happen in China. I think before we had this pullback, it was actually the Polish market that was the best performer year to date. You've had big rallies in Germany, big rallies in Switzerland. Year to date, it's been a theme of international stocks doing better than U.S. stocks. Well, during this latest pullback, especially in the last week, a lot of the international markets gave back some of their gains. And so we'll see who resumes leadership, coming out of the market bottom, whether it's complete or whether it's yet to come. But I am definitely interested as a trader, given the fact that we bounced off of this support zone here in yin, which is the China Bull 3X fund. Okay, so where could we look for? We know there's resistance up here. Okay, and I didn't draw this on this chart on purpose because I almost want you to follow my laser and look at it more closely. Buying yin and looking for a 100% move, you're looking for a steep reward here. But if you're looking to be a little bit more tactical and playing a little bit more short term, check out where this resistance zone is. Follow my laser, right around that $40 mark. Okay, let's call it like $38-40. Okay, so there's definitely, if you look at this chart and you eyeball it, you can see that there is this zone on this chart where there has been some congestion before. And that's basically how you try to spot these support and resistance zones. Look for periods where the price action starts to trade in a more range-bound manner. And when in doubt, zoom out, because these zones that we observe on the daily chart here, in many cases, can be observed on the longer-term time intervals as well. So, I keep going back to that point, because even though these are short-term funds, you need to know what's going on in the bigger picture to increase your probability of being on the right side of the market. The reason being is because you're going to get the biggest directional moves in the direction of the longer-term trend. So what does that mean? Well, if you have a long-term uptrend in a market, you're more likely to get a 10% upswing than a 10% downswing. So by that logic, you want to steer your bias towards the bullish side of the market. That doesn't mean there won't be opportunities on the short side. And if you do see an opportunity like that, take a look at Yang, okay, the 3X bear fund, which had, by the way, a very impressive run up from the sell-off that we saw in the Chinese market and around the world from mid-March. Okay, so these are great hedging tools too. If you have a core position and you want to hedge, you don't want to go the traditional option route, buy some of the inverse funds. If you're looking for a multi-week pullback or a multi-day pullback and you have a good risk-reward entry and you're trading in a support or resistance zone, a great way to hedge. So anything that you're seeing on your side, Elliot, when it comes to China right now?
I mean, with yen last week, with the movements, was one of the largest outflows just across our suite, just looking back for last week at least, and even over the past month, like you mentioned, with the run up, or excuse me, the meltdown in equities globally, but especially with the U.S. and China. And yesterday with Yang, we saw over 100% turnover within the fund, which
Really?
is considerable amount. That happened actually across a good amount of our suite yesterday, some of our largest funds. So a lot of volatility for sure in these names, especially as we kind of see this, trade war pan out between what is more becoming a trade war between U.S. and China than U.S. and the rest of the world.
Did I hear you say that correctly? You had over 100% turnover yesterday?
In yen, we did.
Yen.
So we did have 100% turnover, over 100% turnover in quite a few of our funds, including SOXL and a few others, where that's trading. The notional volume traded, that amount is larger than the assets under management. So it means a lot of live shares are switching hands. You see that a lot in a volatile market like yesterday, or a big swing like yesterday.
That's very interesting from a trader's perspective, because that sounds a lot like maybe not the capitulation, but a form of capitulation in the near term. A lot of people trading more emotionally, and you see that play out usually when a market is forming a high or a low, either on the long side or on the short side. So that's very interesting to hear. Well, let's get into the next market that I wanted to look at, and it's long-term treasuries. Obviously, a lot of action taking place in that asset class as well. We had an inflation report this morning that came in below estimates, and something that I've been looking at, given what's been happening in the energy market. And you might be thinking, well, why am I bringing up energy if I'm here to talk about treasuries? Well, because the price of bonds moves inverse or opposite the direction of interest rates. And as it turns out, the price of crude oil or energy has the largest impact on inflation expectations out there. So when the price of crude oil is dropping, you shouldn't really expect inflationary pressures to rise. And this is one of the things that I've been taking a bit of a contrarian stance on, because if we threw out all the tariff headlines, there's not a lot happening in the market that suggests that inflation is a big problem. Now, we know that tariffs can lead to some higher prices down the line, but could that be offset by some energy prices? Could that be offset by other, regulatory reforms? These are all things to consider. And, when we're trying to make sense of the environment that we're in, just remember that it's not a one-piece puzzle. We're talking about dozens and dozens of pieces that are moving. So, there's been some rumors as to, why we have seen such sharp selling in long-term treasuries over the last week or so. I've seen, people saying, oh, it's China selling to try and support the yuan to raise dollars. Turns out Japan was doing a lot of selling as well. Japan actually owns more treasuries than China does. And then I actually saw there are some big hedge funds that were playing the basis trade, which I'm not going to get into today, that also were forced to redeem a lot of their treasuries. So some of the big hands in the market were forced to do some selling in the bond market. And that obviously played out with a very, very sharp reversal in long-term treasuries. But, year to date, we have seen a nice bounce play out in this. I would argue that the longer-term trend in bonds has turned lower. So, the days of, sub 3%, 30-year mortgage rates, I think those days are gone. But that being said, I do think there are some nice tactical opportunities on the long side in the treasury market, especially if we're going to see the Fed move in the short term. Usually you see a little bit more of an aggressive move on the long side of this market. But, what are we looking for? Well, if inflation continues to be contained, we had some evidence of that today, I wouldn't be surprised to see a little bit of a bounce here in TMF. And the pattern that I have drawn here, the one that's going on, you can call this a symmetrical triangle pattern. And so, we discussed the trend a little bit. We discussed support and resistance. The next step is really to sprinkle in some patterns, because when you understand how certain patterns are categorized, it helps you build out a trading plan. So here's what I mean. We're looking at this symmetrical triangle, otherwise known as a continuation pattern. Continuation of what? Continuation of the trend. So the longer term trend, as I mentioned, has been down in bonds. So what I would look for in this pattern here is if we start to break below this lower trend line, okay, we're probably going to see a continuation of the downside. But on the flip side, we've seen the short-term trend year to date be up. For a little bit there, we actually had bonds, long-term bonds especially, outperforming stock. We start to clear this upper trend line here, see a continuation of the short-term trend, and we could look for some upside in bonds. So, there's a lot of factors that go into play here, and believe it or not, it's not very sexy, but the bond market is a lot bigger than the stock market. That's where a lot of the action takes place. So not something to ignore totally. And if you don't want to trade futures and, you actually want to take some, speculative bets on the direction of treasuries, these triple leveraged bond funds are a great way to go about it. So here we have TMV, the Bear 3X treasury fund, and it's a similar story. In this case, I would almost categorize it more like a descending triangle, which is, also in the category, the classification of a continuation pattern. But you can see here, we're trying to break above this upper trend line. We'll see how it plans out today. But this could provide an opportunity if you think long-term interest rates are going up, which is in the cards. It is certainly a scenario to consider here. TMV may be a trade for you to take. So what are you seeing in the treasury funds here? Because I think this is where a lot of the action is taking place. We talked about chips, we talked about China. This is a totally different asset class. So there's a lot of different plays in this market right now.
Yeah, no, definitely. You mentioned it, treasuries in general, really a strong selling off of yesterday, the open, and the day before as well. You saw yields rising, 10-year getting near 4.5%, and seeing significant trading pickup in both TMF and TMV of short-term tactical trading. I'd say definitely, the question right now, and it looks like the Fed is going to hold. They're leaning towards keeping rates steady, but that's definitely can be a mover for treasuries if they've been good about not having any surprises. But we'll see if there's any rhetoric or commentary from any upcoming meetings or notes, where there's any hint towards upcoming cuts, which it doesn't seem like right now, but to be seen how all this plays out especially with the tariffs right now.
Just to give you an idea of how volatile the bond market has been, and just remember, when the Fed moves on interest rates, it's in the short term. There's different interest rates for different time frames. So you're not actually, if the Fed is raising or lowering interest rates, you're not really playing that trade by buying or selling TMV or TMF. So I want to be very clear about that because sometimes people get confused. But just to give you an idea of how volatile even the bond market has been this year, we've seen rate cut expectations go from 2 cuts this year to 4 to 5. And then we were looking at on Monday or Tuesday, the Fed cutting interest rates in May, like you said. It was like an 80% probability at one point. Now they're not moving. It looks like they might move in June. So it's really been all over the place. And so as we go through this exercise on technical analysis, this is what can give you your edge as a trader. Trading by the headlines in this market, guys, I wouldn't do it. I wouldn't do it because we are one tweet away. We are one economic report away. We are one geopolitical development away from massive reversals. What trading by the charts enables you to do is define your risk versus your reward. If you're buying on a support zone, you can say, okay, I'm going to buy here, and I have my stop loss at this percentage amount. I have my price target at this percentage amount higher from current prices, and you're able to measure your risk versus your reward. Just like me personally, I won't take a trade on unless I can make at least $3 per $1 that I'm risking. So these are all considerations you need to take in this market. And that's why, we're going through this exercise and looking at some charts and patterns and trends and, support and resistance zones, because these are some of the, simple and practical tools that can help you define that risk reward. Because again, in this volatility, I wouldn't be trading based on those headlines because they can turn on a dime.
Yep, I completely agree with that. Having a plan and executing that plan instead of trading on emotion or headlines, because there's a lot of volatility with the headlines, in the past couple of weeks.
And let's be clear, like yesterday's move, you're sharing. I didn't know before we got on this session together that we had over 100% turnover in yen. I mean, that is not. That's an emotional move, right? that is not based on rhyme or reason. And obviously these funds are reacting to their underlying, index or asset that they track. So That's why it helps to know, what these funds actually track. And let's get to the next one. Gold. I mean, it makes me think of Austin Powers Gold Member whenever I look at this index and this market. But honestly, I'm so impressed by the performance of precious metals this year. It is by far the cleanest uptrend that we see in markets. Forget stocks, forget bonds, forget crypto. Gold has the cleanest uptrend. And we're not looking at the price of gold here. We're looking at the price of the New York Stock Exchange ARCA Gold Miner Index, which is the index that Direxion's triple or double bull and bear, right? The double bull and bear funds track. So let's kind of break it down here. We're looking at a weekly chart. Again, longer term trend. Know what's going on. Gold miners have actually been trending up since 2022. We simply see higher highs and higher lows. We then broke out from this saucer formation, which is a very bullish pattern. And you can see how you saw prices kind of congest and trade in this like 10% range between summer of last year and the end of last year. We finally broke above it. That was resistance. It's become support. We've come back down. We held that former resistance turn support zone, and in the process may have completed a higher low. How will we know that a higher low is completed? Well, when we take out the high from a couple weeks ago. It's that simple to understand. So my bias is going to be for looking for the bigger moves on the bull side. That doesn't mean there won't be opportunities on the bear side. But again, I'm all about stacking the probabilities in your favor. So if you had the choice to trade between a 10%, or I should say a 20% move to the upside or a 5% move to the downside, which do you think is going to provide you the better outcome as a trader? These are the types of questions that you need to be asking yourself before you take on a trade, because I found that in this trading business, it's not necessarily about having the right answers, but in many cases, asking the right questions. And I think that's one that needs to be at the top of your list. So let's get into these funds here. Nugget, that's what I like to call it, NUGT. Really strong setup here. You have that similar saucer formation that we looked at in the chart. And look at this gap and run higher. We gapped up yesterday from Tuesday's closed, finished at the highs of the day. I'll tell you what, this thing starts clearing 62, 63 bucks per share. I wouldn't be surprised to see gold miners rip. And in fact, today, once again, gold miners are some of the strongest trending names in the markets. I'm watching a few individual gold names, which I'm sure a handful of them make up some of the holdings in this gold mining fund, plus leverage. A lot of them are making multi-year highs or even new all-time highs. So that is very much a good sign for the bullish case. And believe it or not, new all-time highs are bullish. I know we get into this mental trap a lot of times. You hear it kind of just thrown around, and you can sometimes believe it, and it's not always the case. But buy low, sell high. I'm here to tell you, you don't have to do that to be a profitable trader. My best trades in many cases comes from buying high and selling higher, capitalizing on the momentum in the market. And right now, some of the strongest momentum that I'm seeing is in the gold mining space. So I like gold miners to the upside. With all this geopolitical uncertainty, trade uncertainty, gold really functioning as I hesitate to say safe haven asset, but it does do well in heightened levels of uncertainty. And I would argue that right now there is even more uncertainty than in quote unquote normal times. But what is really normal? And one other comment I'd like to make on the fundamental side, a lot of these individual gold mining stocks have really cleaned up their balance sheets. They've really cleaned up their cash flow, and they have some of the strongest fundamentals in this market. So, if you do like to look at the fundamentals of a stock, of a sector, I think you'd be pleasantly surprised by what you are seeing in the gold mining space. So you could see even more momentum to the upside in these miners as more and more institutional funds in this market seek those nice cash flow and those nice earning multiples. But I don't want to make it seem like, oh, if you just buy gold, all your problems are going to be okay, solved, because that's not the case at all. If we are entering some sort of economic period of turbulence, if we do go into recession, if we do see a liquidity crisis, you go back and look at 2002. Let's actually go back here. Gold miners did not do well in 2022. Okay, it did not do well. So gold and can do well in select environments, but by no means is it your hedge against market uncertainty. If we do see a liquidity crunch, I would expect these to reduce or to reverse back down lower. And in that case, the gold dust fund, could provide you an opportunity to protect some of your portfolios. So yeah, I think the opportunities in gold are huge. Again, my bias is to the upside right now. But again, if we do see some sort of liquidity crunch or a credit crunch come about, I don't think gold is going to be spared. And you even look back just like a few days ago, look at what happened in the price of silver, just absolutely imploded. It went from like, I think it was like $34 to like $28 in a matter of a few days. So it got crunched. You had margin calls. And when those margin calls come through, nothing gets spared. Nothing gets spared. So, definitely be aware of the opportunities with dust in addition to Nugget.
Yeah, no, I definitely, I like that you definitely mentioned that this is gold miners, not gold. Of course, gold has, is a proxy for these, and all these equities are heavily involved, in the process of gold mining. And yeah, we've really seen last year gold and gold miners, but gold specifically had a great year this year so far. But even to your point of not wanting to necessarily call it a safe haven, we saw gold miners selling off with the rest of the market when these tariffs were announced. So if you were seeing a true, I don't know if there's really any true safe haven, you wouldn't see that sell off. But it's a great way to trade around gold as a proxy, using the gold miners. There's definitely been, as of today, some incentive and giving the bid to the miners and gold with the potential stimulus coming out of China. Again, I know you mentioned don't trade around the headlines, just providing some color around that,
Sure.
Why things might be moving.
Yeah. Well, I do think that there's some great opportunities in metals going forward. Okay, let's get to the individual stocks, because I love how you guys have come out with these over the last several months. I think it's probably been even over a year now. I mean, when did you come out with these individual stock funds?
Yeah, we're coming up on just over 2 years. We're coming up to it. We were some of the first movers in the space, and as you've seen, we've really developed the suite beyond. We started with the Magnificent Seven, and have really developed beyond that with some recent launches of Eli Lilly, Palo Alto, but we've also have across the semiconductor and chip space. So a lot of names and great ways to, for every single stock pair we're putting out, as you can see on the screen, Apple, we're always going to do a 2x bull and then a single inverse bear. So a way to trade long with leverage, or inverse as hedging possibility if you have a concentrated position, or if you're looking to take actually an outright short on the name. And we see a lot of trading around earnings, especially in these names.
Well, I just think it's really cool that we have a way now, outside of selling short, with margin or without options, to hedge. I mean, it really speaks to the innovation that's happened in this space. Because when I started trading, this stuff wasn't around. But let's get into the technical situation of Apple. Apple, I would argue, probably the most important stock in the U.S. market right now, and obviously they have a large exposure to China. And I think that given the changes that could be coming on the fiscal side and the tax side, they're a little exposed now. And it's interesting to see how you had this big gap down. In the recent past, you gap down, and when you gap down below a support zone, that is ugly. That is ugly. A lot of times we'll call this a breakaway gap to the downside. And, just for context, the price of Apple went from around 220 to a low of 170 in the span of, what is that, 1, 2, 3, 4 days? I mean, you do not really see moves like that play out in Apple very often. You have to understand how much volume, how much transactions, how much buying and selling, the amount of money that is invested in Apple. All these ETFs, QQQ, SPY, if you have a 401k, you put it into those funds. Well, who do you think they buy? They buy stocks like Apple. This is, I would argue, the most important stock in the market in the US. But I'm not exactly pleased with its technical outlook because I would like to see Apple do well. It does raise some concerns from my standpoint because you did break below this technical support zone. So what does that mean? We discussed this earlier. It's now resistance. So Apple below 210, Apple below, let's say 210, this 200 to 210 zone, it's got some problems. It's got some problems. And, you hear a lot in trading, gaps get filled. Yeah, they often do. They often do. But look at this. You have a gap here in Apple around, 255. You have a gap here around 250. Are all these gaps going to get filled? Maybe. But if we're starting a multi-month bear market, how long would it take for those to get filled? So these are all considerations that you need to think about before you, say, there's these gaps. I'm just going to buy the 2X AAPU fund because I'm going to look for Apple to recover easily. Well, it could take a lot of time. And we know that there is, some of that performance decay that you get from holding these funds over long periods of time. So, if Apple can close this gap, hey, I'd be happy to see it, and I think that it'll send a good message for the overall market. But bulls definitely have their work cut out for them. So I don't know if there's anything else you wanted to add on Apple. I do have a handful of other individual names that I wanted to look at today.
Yeah, let's keep moving through because I do know you have a lot of great names on there.
Amazon. So you can see it's dropped below this support zone, not as dramatic as Apple's. So I'm not gonna try and figure out a reason or tell you, it's because of this or that. All I can say is that based off the charts here, the trend has turned lower here. You can see how you took out that low from November, you took out that low from October, but you did not take out that low from August. You go back to Apple, you did take out that low from August. So I want to bring up this other subject. It's called relative strength. Relative strength. You may have heard that in trading circles or in financial circles. What is relative strength? Well, it's about focusing your buys on the strongest stocks in the strongest sector in the strongest market. And then if you're selling the weakest stocks in the weakest sector in the weakest market. So I call it almost like financial Darwinism. The strong get stronger, the weak get weaker. And honestly, looking at this technical picture, Amazon compared to Apple, Amazon looks a lot better. Amazon's more of a marketplace, right? Yeah, like they've gotten into everything. I mean, I even get like groceries delivered from them now. It's crazy. But Apple is a little bit more niche in the tech space. They have a lot more business in China. Obviously, Amazon's selling a lot of Chinese products, but not as invested in the Chinese economy as Apple is, that I would argue. So you do have some gaps here too, but you can see you're already testing this former support turn resistance zone. You get back above here, Amazon could be back in business before Apple. So I would actually be favoring Amazon more than Apple in this market environment. I'm just going to keep going through, Elliot, and if there's anything you want to chime in on any of these individual names, feel free.
Absolutely.
All right, Google. Google is a really interesting case study right now because I've seen, according to various fundamental or valuation metrics, Google or Alphabet, it's like I grew up in a time, it's going to be Google for me always. It's like Twitter. I'm always going to call it Twitter, even though it's X, whatever. So Google actually is less expensive now than it was in 2020. You want to talk about things being on sale. Google's very much on sale from a fundamental standpoint, but we know that we're not basing trades. We're not thinking about trades from a fundamental standpoint when it comes to these leveraged funds. We're thinking about it from, multi-day tactical swings and things like that. So here too, what did you do? You started to test the support zone. Google actually made a lower low in September. You did take out that low, but it looks like Google could be trying to break out from what's called a falling wedge pattern. These are reversal patterns. What is a reversal pattern? I touched on continuation patterns earlier. What is a reversal pattern? A reversal pattern means a reversal of the trend. The short-term trend has been down. You've been making lower lows and lower highs. So what happens? Well, if you clear this upper trend line here, maybe look for a bounce. Maybe look for a bounce. But first and foremost, we need to see this support zone hold. It closed well yesterday. I would argue it closed better than Apple and Amazon, but there is more work to do. So I like what's happening in Google. If you like the long side, GGLL. If you think we're going lower, GGLS can give you some downside protection. NVIDIA. Wow. Well, I talked about the importance of semiconductors at the beginning, and we've come full circle here because NVIDIA is the most important semiconductor stock in this market right now. The AI revolution would not have been possible without NVIDIA. Here too, you saw that August low taken out to the downside. But I must say, we didn't fully break that support zone. That is a good sign. So, NVIDIA above 95, 105, we're holding that zone. I think, if you are looking to be a bit of a contrarian in this market, that's a dip buying area. But you break below there, I think you need to liquidate. I think you probably should be focusing your efforts more on NVDD versus NVDU. But, above that support zone, 95, 105, I like what's happening here in NVIDIA. All right, moving on. Tesla, it's been quite the round trip in Tesla over the last 6 or 7 months here. It went from one of the worst performing Mag 7 numbers to one of the best performing Mag 7 numbers to one of the worst performing Mag 7 numbers again. So here too, you have this support zone. You bounced off at 215, 245, and you have this falling or descending channel here. Okay, these are actually continuation patterns. You don't see it on this daily chart here, but if you zoom out on a long-term chart of Tesla, you will see the long-term trend is still up. This was actually an all-time high in the price of Tesla. Okay, prices never got higher than where they were in December. You clear this 300 level or above this upper trend line, look at the long side. But this trend line is going to act as some resistance. I would not be surprised to see some selling come back into the picture here. That being said, if we're above 215, 245, hey, you want to trade in the direction of the longer term trend, you consider TSLL. You break below 215, 245, I think TSLS is the better trade to take.
Yeah, and we've seen in TSLL, that's been the largest inflows across our entire suite, that ETF this year, which has been, you can see right on your chart exactly, a lot of traders looking to kind of get that trend reversal by the dip. Short term, that's worked out in pockets. Long term, from the beginning, of the year till right now, that has definitely not worked. But we've seen a large activity pick up, and that's probably that is our largest single stock ETF, and like I said, the largest inflows across our entire suite of 100 ETFs this year.
Yeah, I mean the move in this has been huge. We're talking about a 50% correction in this Mag 7 name over the course of the last 4 months. So that's big. Palantir actually holding up better. It's been one of the strongest performing stocks in this market. You can see here there's a symmetrical triangle pattern ascending. This is a continuation pattern. So you take out this high from last month. I mean, you can make a case that the trend is going to continue to the upside. So I like Palantir. I know this is a newer one that you guys recently launched. But I think this could be one of the hot stocks going forward if and when this, I shouldn't say if, but when this market actually bottoms. And then Uncle Warren's stock, Berkshire Hathaway. Okay, this stock, you want to talk about relative strength. It was at all-time highs just a few days ago. Okay, one of the strongest performing stocks in this market falls into the financial sector, but you had this big breakout from the saucer formation. You can see how that played out. Projected about a $60 move that was satisfied. The high right there was at 540. Perfect. 540 minus for 80, 60 bucks as measured from this pattern. That's a really good setup. But hopefully you captured some of your profits on that last move when you hit that that measured projection, because you had a pretty sharp pullback. But what was it all about? What did you do? You just retested former resistance turn support. So there you go. Textbook technical analysis playing out. And I do want to wrap up with the Broadcom, a semiconductor stock. I'm really glad to see how this one held technical support. You want to call this a falling wedge or a descending channel. A little bit of a gray zone there, but this too could emerge as a leader if and when this market bottoms. So just to wrap everything up and just discuss with leverage, can be very rewarding, very cruel. You cannot afford to stay wrong for long. Like I said, I don't take a trade unless I think I can make at least $3 for $1 that I'm risking. And the way that I trade, my break-even rate is only around 25%. So if you're thinking like, how is that even possible? Well, these are things that you need to think about before you even start getting into trading at a serious level. So I'm a big believer in cutting losses short, letting your winners run. And, like I said, I only need to be right 1 out of 4 times to not lose money, assuming my winners are 3 times the size of my losers. So, Elliot, that's all I got for today. If there's anything else you wanted to touch on.
Yeah, no, I was just going to say that anything, that you want to see from about leverage and inverse ETFs, more on the single stocks, more on the education of just how these work, the daily rebalance, compounding with leverage. Our website, Direxion.com, has all of that great overview videos. Highly recommend, if you are new to leverage and inverse, to take a look at that first, because we want to make sure that anybody that is trading our ETFs understand the risks involved with trading a leverage ETF. But that's it, and it was great being on here with you, Gianni, today.
Likewise, Elliot. Thanks again, and everyone, thank you so much for joining us today. Definitely take a look at these funds in this volatile market. Gives you a way to play both sides of the market, and you definitely want to be keeping an eye on your positions with the way the tape is moving, though. So this isn't set it and forget it. You need to actively monitor your positions. So that's all I got, Elliot. So thanks again.
Hey, thank you, Gianni. Looking forward to next time.
All right. Take care. All right. Thanks again for joining us today, everyone. You can find more information at www.direxion.com. They have a whole suite of leveraged and inverse ETFs, in addition to those single stock ETFs, which I think are going to be very useful in this market environment filled with volatility going forward. So until next time, everyone, see you later.